Good evening and welcome to our next Libro event in our Let's Make Money Better webinar series. Tonight we're going to have a presentation about the family cottage, succession planning, and all those kinds of things. We do have a number of these webinars that we've done over the last several months. We certainly invite you to visit those at our events page on our Libro.ca website. My name is Paul McQueen. I'm the VP for Wealth at Libro Credit Union, and I'm really excited to be here representing our staff in this presentation for owners and potential owners of Libro that might be interested in learning more about the family cottage. We're very excited to be joined this evening by Doug Carroll. Doug Carroll is the tax and estate specialist at Aviso Wealth. Aviso Wealth is the parent company of our investment dealer that helps Canadian credit unions across the country deliver investment solutions to our owners and members. Doug is certainly skilled in the implementation of tax, estate, and financial planning strategies, and he likes to describe as helping people, his role in helping people convert wealth into well-being. He provides practical professional insights that expertly guide not just investors, but also advisors in areas like trust and estate law, personal and small business tax, insurance, investments, and financial planning. Doug has a lot of experience both in the investment field, in the legal field, and is a regular presenter on many forums, including things like 680 News, Advisor.ca, BNN, CTV, National Post, Toronto Star, Globe and Mail, Morning Star, and the list goes on and on and on. Tonight's topic around the family cottage is certainly one that we know from experience that individual owners have a lot of experience in. From personal experience, I have seen this topic, handled really well to promote family harmony, and sometimes, unfortunately, when not handled well, adds to a little bit of family dysfunction. That's certainly one thing we'd certainly love to avoid. With no further ado, I'd like to turn it over to Doug Carroll and tonight's topic. Mr. Carroll, over to you.
Okay, thanks, Paul. I'm going to take charge here. Just let me know that I've moved the slide forward. We've got the header slide now with the title Cottage and Cabin Succession up there.
All looks good, sir. Yep.
I'll take it from there then. Appreciate everyone joining us today, and it's certainly a bright and sunny day over on my part of the province, and I'm assuming likewise with you. It's a bright and sunny day, so appreciate you taking the time to sit in on this session with us to talk about this this topic, cottage and cabin succession. I talk about this across the country, so do it from from home these days through webcast, but it is something which is very relevant to families and is probably in my experience when I did run law practice, is probably the most challenging topic that parents will deal with when they come around to their estate planning, is figuring out how they go about dealing with the family property. So I'm going to take you through a number of topics here. I've got the agenda of topics up in front of you here, about 10. And that's roughly the slides that I'm going to bring up here. And some of it is more framing things up in the first place about the nature of a cottage or a cabin, and why it is unique among the things that people own and the kind of emotions that it carries. And then I'll talk about one of the key issues that comes up from a tax standpoint, is what to do, to be aware of, and how to manage the capital gains that can apply when there is a change of ownership on a property like a cottage. And then from there, I'll go through some ways that you can address it in terms of it possibly being your principal residence at some point in time. And then when you do transfer on the ownership, some options that you have in bringing other family members in to be owners, or transferring to them so that they will be taking over as owners. And then just a final point that I'll make about the role that insurance can play, to try to help out with the taxes that may very well arise, as well as providing some additional funding where necessary to sustain the cottage as it carries on into the next generation or two, if you wanted to make use of life insurance for that kind of purpose. So the first thing to bring up, and I'm just going to again frame it up a little bit in terms of the nature of what a cottage is, and why it is different than other things that do have dollar value, but don't necessarily have the kind of appeal that you're going to wrap your arms around it. So a cottage is very much a family gathering point. It is a place where people do go for special occasions. Sometimes a special occasion is the entire summer. Sometimes it's the occasional weekend. It might be special gatherings of extended family. So we tend to associate a lot of memories with it because it's a distinctive place where we have those joyous occasions. And it's got the combination of a connection of the current owning parents back to their own history of how they enjoyed it, the current family they have and how their own children and they might have enjoyed it while the children were growing up, and then the hopeful anticipation that the children will do the same, that they'll be able to carry on. So it has that very important emotional attachment that makes it difficult to detach from in a lot of ways. When you're looking at the cottage as an owner, as a parent who has the cottage, then you do want to be practical about it nonetheless, and think about whether the children indeed want to carry on the ownership of the cottage. I had a number of occasions, both from the estate planning standpoint of talking to parents who were looking through at their cottage, as well as some estates that I was dealing with in law practice, where the parents' desire to have the children take over didn't match up with the children's own interest or capability of doing so. And so all of the preparation ahead of time sometimes would have been for naught, because the children really didn't want to or just could not carry on and own the cottage, couldn't afford to do that. If you are looking at transferring on to them, one of the questions to ask is, do they get along? If there's multiple children, if you want for them together to take on the ownership of the place, then are they going to be able to do that? Do they share in a reasonable way? Are they organized enough to do it? And that's not to say that you say, oh no, they're not organized, forget it, we're not going to even try. But bear that in mind, that it can create a lot of angst among them if they are not prepared to step in and do that. So would you give it to them now based on their ability to manage both the finances and their relationships and the property itself, physically manage the property? And if you wouldn't do that now, what might you do to get to the point where would they be able to do that? If you are not going to give it to them, but you are going to sell it to them, again, do they have the money to do that? Sometimes when people have the cottage that they own, it is certainly a place where we've got all those memories associated with it, but it also has a very substantial amount of wealth tied up in it. And in some families and some parents in their retirement planning, it might actually be a source or an eventual source of retirement income. So you do need, in some cases, for the children not just to receive it outright as a gift, you need for them to buy it off you, or at least to provide some kind of return to you, so that you can, in fact, use the funds that are tied up in it presently to sustain your retirement. And then the other part of it is, can you afford to give it to them if you are going to give it to them? Because, as I already mentioned, and I think this is a well-known concern, there are going to be taxes that are quite often going to apply when you give away the property. Although some people get very surprised that if you give it away, you are subject to tax on the gift, potentially because of the capital gains. So just going through just a few more points, and then I'm going to get into some numbers here. And I'm going to try not to floor you with the numbers, but I'm going to give you a reasonable example of what might happen with the calculation of capital gains, so you can get a sense of the proportionality that comes up with them. So when we have cottages, when we have any kind of property, really the real estate that we have that we own, there is a long-term growth in property value, and particularly with recreational properties, depending on what region of the country or what region of the province you might be in, there have been some substantial gains in the last couple of decades. And so because of those substantial gains, you have that growth in value that eventually will lead to a capital gain, and there's tax on the capital gain. And when we look at the property and you may have built upon it yourself, you might have added on to it additional buildings or new components built off the main property, that might also add value to the property. And critically important to that is keeping the receipts associated with building that, because that can also affect your capital gains tax calculation. So do you have a capital gains tax time bomb ahead of you if you have not yet planned for what it is that's going to happen when you undertake the transfer of that property? So capital gains, again, we have to look at the cash flow that is going to come from transferring the property. Again, I'm sorry to convert from the warmth of the emotion of the day into this cold hard cash, but there is truth to it, that there's cash that is going to be needed to deal with that. When you have a sale of a property or a gift of a property, a capital property, then you are going to have a tax liability that arises from it. So would you look at it as it's time to then do a current transfer of that property, not necessarily today, but would you do it during the course of the time that you own the property and allow for there to be a capital gain arising out of that and a tax to arise at that time? Or might you consider doing a transfer that will perhaps delay the point at which the tax will apply? So you might use a trust, and I'll give you a couple of examples of that. I'll give you some better visuals than this green piggy bank here, how you might be able to use a trust to perhaps defer the disposition so that it happens at a later point in time. And if you completely delay and you wait until the point when you die, as between you as spouses, you can transfer a property back or in one direction or the other, and you can defer the capital gain. But on the second death of the two of you, then there is going to be tax applied at that time. So the tax needs to be paid in order to satisfy the tax revenue agency. If there's no liquidity available in other places to pay that tax, then the source of paying the tax may very well be the sale of the cottage itself. And that's why having you join us here and thinking this through, as much as it's very technical kind of look at a cottage, it is important to know what it is that may be ahead of you, so that if you do want to preserve the cottage going down into the next generation, or maybe even beyond that, that you are prepared for the finances that are necessary for that to happen. So where is the liquidity going to come from in order to make sure that the taxes are able to be paid? So as I said, I'm going to give you a bit of a calculation of capital gains. And when you have property that you own that grows in value, the growth in value is a gain, a capital gain, and tax can apply on that gain, whether you have an actual sale to someone or a sale is deemed to have occurred. And the deemed kind of situations are when you don't actually sell, but it's a transaction where there's a change of ownership such that it is treated or deemed to be a disposition, and the taxes may very well apply at that time. And I say may because in some cases, again, you can roll over with spouses. The kind of deeming situations, as I've already mentioned, would be making a gift of the property, or your own death could be the triggering event that causes that to be taxed. And the gift, the value at the time of the transfer is the fair market value of the property at that time. So if you're making a gift, some people will say, well, I'm just going to give it at for $1 in natural love and affection over to my son. Well, that's nice that you feel that way. You're not going to take anything back from your son, but for tax purposes, it is deemed to happen at fair market value. And so any taxes to you as the giver will be based on fair market value, not the lovely dollar and the natural love and affection that you've transferred over to your son to do that. And fair market value is not what you might feel is as the appropriate amount among you within the family. It is truly an arm's length. What would someone out there on the market pay for this thing? And that is going to be the determination of what the value is that you do the calculation of the taxes. And the difference between the fair market value on the disposition and what you have as your adjusted cost base, that's your capital gain. It's called adjusted cost base because it starts with your original cost of acquiring the property. And then if you have expenses associated with doing that acquisition, then that will increase your cost base. If you had to pay an agent in order to make the purchase, that will increase your cost base. And if you make improvements to the property, that will also increase your cost base. And then we have the big event for a lot of people in terms of owning cottages was the capital gains exemption, the lifetime capital gains exemption, which was introduced in the mid 1980s and then was eliminated in 1994. It was a $100,000 capital gains exemption that was available during that time. And it was something that when it was eliminated, a lot of people took the opportunity to bump up the cost base of the property they owned by as much as $100,000. So all of those things will contribute to the base above which you have the capital gain. So here's my example that I have that you've been able to look at here, and I'm going to walk you through the steps involved here. Pat bought a cottage for $300,000 20 years ago. Pat paid $1,000 per year to the property maintenance company and added a sunroom for $40,000. The cottage sold for $500,000, less real estate commission out of the selling costs of $20,000. And to make it good round numbers that we can follow, I'm going to put Pat at the top tax bracket, at the 50% tax bracket. So you see the formula here for the tax calculation is the fair market value on sale minus the adjusted cost base is our capital gain. Fortunately, only half of capital gains are taxable, so that's our 50% inclusion. You multiply that by the person's marginal tax rate, and then you get the taxes that are due. So in this case, the fair market value is $480,000. So it's the $500,000 that was sold for minus the $20,000 in selling costs. So Pat netted $480,000. And then the adjusted cost base was the original $300,000 plus the $40,000 for the sunroom. The $1,000 a year that Pat was paying for the property maintenance company clearing the snow or whatever it is that they did, that's just a cost, a personal cost out of pocket. It does not affect the cost base. So only the $40,000 is available to reduce down the capital gain, which we have at $140,000, and then half of that is $70,000 multiplied by Pat's marginal tax rate of 50%. Then there's going to be $35,000 that has to be paid through to the Canada Revenue Agency at that point. So kind of a step-by-step that I've been taking you through that, but I just wanted to make sure that we were clear on what happens, because it's somewhat of a mystery sometimes when you have a capital gains calculation. You're never quite sure in some cases, how big is this or how small is this? So there gives you an example that might apply. Paul, I'm just going to stop there just to check whether there's any questions that came up. I'm not monitoring the Q&A, and so I'm just going to ask you if I have anything that you want to hold me up on, and I'll continue on once I've done that.
Oh, thank you, Doug. Well, Paul, myself, I made a bit of a goof at the beginning of the presentation where I forgot to point out the chat function on today's presentation. We certainly do welcome questions from the audience. The nature of the format and how we're delivering today's webinar doesn't allow for verbal questions, unfortunately. So if you do have a question to ask, please feel free to put it in the chat. I put an announcement in all there already. My apologies for not bringing that up at the beginning of the call. We'd love to answer questions. We're certainly more than happy and willing to answer sort of general questions and even specific questions to a point. If you have a very, very unique situation that might involve a little more exploration, we'll perhaps be looking to defer that to a conversation with one of our coaches, and could bring in Doug as a resource or others as needed. So my apologies again for not bringing that up. So because I didn't bring it up, Doug, I think that's led to the natural conclusion that there aren't any questions in the chat yet. I have a couple to ask you, but I'll let you go through your presentation and see what comes up.
Okay, and I probably should have said off the top, as I'm going through this material, and again, I do it from time to time. I generally go through the whole thing in about a half an hour's worth of time. So we're about halfway through it right now. So
One question
you
did
can
come up,
throw things
Doug.
in. Okay,
One
there you go.
question did come in from Jeff. Do you feel that the inclusion rate will increase in the next few years?
Okay, so that's a question that one, I don't know, and anyone who says they know, they don't really know whether it is, unless they're in government and they're part of the inner circle and can actually make policy. So it's always a rumor that comes up year after year after year. I think that although I don't know, I would look at it in a few ways. One is we definitely obviously are in a position where much larger deficits, like hugely larger deficits that we're facing now with this pandemic. And so the governments, both provincial and federal, will be looking at ways that they can generate tax revenue. So that might be some impetus behind it. But the other thing to think about, that aside, is that the rate, the 50% rate, which it was from the time that we had the big change to the tax system back in 71, 72, it was a 50% inclusion rate from that time until, again, the mid 80s or the mid to later 1980s, when it went up to 2/3 and then as high as 75% at that time. But, and I already made mention of it, the capital gains exemption, that was brought in conjunction with giving everyone a lifetime $100,000 capital gains exemption. So although they increased the inclusion rate, they gave away $100,000 of non-taxable gains that everyone was entitled to. So that was the giving with one hand, taking with the other. I think that in fairness, if the rate was to go up in some way in the next while, whenever it might be, there would have to be some kind of acknowledgement of that sort to make it palatable. And certainly with a minority government, if that's what we're facing right now, and that's what we will have maybe in the next election, I think it would be a challenge for a government in a minority position to bring that in, but it could very well happen. I just don't know whether that's the case right now. Sorry for the long answer.
No problem. There's two questions related to the ACB and another question related to an executor. I may defer the executor one because I believe some of that gets into the later part of your presentation. But the two ACB questions, the first one, so sorry, ACB, adjusted cost base. Apologies for using the acronym. If you do not have a receipt for your renovations, are you able to add it to the adjusted cost base?
No. Let's
prove
say
it.
that
Basically, CRA is always going to
prove
take
it.
to prove it.
Yeah. Whether receipt or not, you've got to prove it. I had a situation I was dealing with. It was a client situation just in the last couple of months where the father, actually the grandfather, I guess it was, they had the land and he was great with his hands and he built everything himself. Well, his labor, his physical labor was not something that contributed to the ACB. If he had been somebody like me who's all thumbs and had to hire somebody to do it and could show the receipts of hiring somebody to do that work, then that would have been something that could have been added to the ACB. So that's something to be aware of as well, because sometimes people think, well, I did all these things. I built this sunroom, which would otherwise be worth, in my example, $40,000, but I did it myself. I should be able to increase the ACB by that much, but you'll only be able to make use of the receipts for the materials if you did it yourself. If you hired someone else to do all of it, then you'd be able to use all of that for the ACB.
So that answers Lisa's question. Does sweat equity, what I actually contribute in work towards the renovations and repairs and upgrades, count towards the adjusted cost base, which you just answered that unfortunately it would not, although it would save you money today, obviously, in labor costs and other things.
Yep.
There's a question about if you're keeping receipts. So if you don't have the renovation receipts, the rentals cannot be added to the adjusted cost base. So we've answered that one, I believe, that CRA would take we want the receipts. There's another one here about building a cottage many years ago, about starting in the 50s, I assume the 1950s and not the age. How is the adjusted cost base calculated? But you're going to have a little bit of that, I think, momentarily, correct?
Yeah, I think this is most of what I've got on the capital gains calculation itself. That's a tough one back in the 1950s. The example that I was just giving you there was back in the 1970s when the work had been done, and even there, it was very challenging for them to try and figure things out. They didn't have the records, and the land records were also very hard to track down at that time in the 1970s in that example. So in the 1950s, and that definitely is going to present a challenge to try to establish what the cost base is. It would be the cost base, although the activity happened in the 50s, it would have been as of December 31st, 1971. I should get that right. 71, 72 is when the new tax rules came in.
And that, and in fairness, that would only apply if you yourself had owned the cottage since the 1950s. Your cost base would be presumably based on the day that you own the cottage, correct?
Right. Yeah, certainly that would be the case. And if you have the transfer down generations, then the transfer from parent to child, adult child, that's a transaction which would establish the cost base for the receiving child at that point, even if it was just a gift over to that receiving child. Now, that could get somebody in hot water if it ever came to light that the parent didn't pay any tax on the capital gain going from parent to child, but you're going to be looking back decades, or the auditors will be looking back decades to try and figure that out. It is your responsibility, though. It is a taxpayer's responsibility to show their entitlement to a tax benefit or a tax result, not for the CRA to disprove it. So don't depend on being able to make a really wonderful argument and then you win. You've got to make the case, and they can then respond to it. They don't have to make the case against you.
Right. So the fair market value, FMV, how would that be assessed? A real estate letter of opinion? Do you have to have a full, the word just went right on my head, appraisal done?
Appraisal, yeah.
Appraisal, there's the word I'm going for.
Yeah, well, I'll tell you that definitely from a probate tax standpoint, we're not talking about probate tax here, but from the change in the rules and the probate laws here in Ontario in the last 7-8 years, the Ontario government was taking the position, or is taking the position, that generally you need to have formal appraisals related to the property that goes through an estate. So if that's the way they feel about it in terms of probate tax calculation, similarly, if you want to have the best possible evidence, a full appraisal will be necessary. Now, if you don't get audited and you get a letter, an opinion letter that is from a professional who can give you a reasonable comparative against that property, that might be sufficient. The auditor might, if you get audited, might say, okay, that's fine. That's a reasonable approach to it. It does depend on the auditor, though, what kind of evidence they might be looking for.
Fantastic. So Doug, there is 2 more questions. I'll hold them. The first one I mentioned already around the executor. We'll come back to that one. And the second one is with respect to the exemptions and some of the rules that changed in the late 80s and 90s. And I know you have some details about that, so I'll save that question to a little later in the presentation.
Okay, so when I say I'm not going to give you more calculation of the capital gain, but I'm going to continue to talk about this issue of the capital gain here. And one of the ways that you can reduce or eliminate the capital gain is the principal residence exemption, or for short form here, the PRE. Although I never actually say those words when I'm writing it, sometimes I'll use that, but I don't actually say it. So the principal residence exemption, as everyone likely knows, is one of the really nice benefits that we have in the tax system, where we have the ability not to be taxed on capital gains for our principal residence. And in order not to be taxed on that, a principal residence means that it has to be a property that is ordinarily inhabited during the year. It's not a matter of saying, well, I'm in this property for 10 months of the year and I'm in another one for 2 months of the year, and therefore the 10-month property is the one that is ordinarily inhabited. It's not quite so much of a firm test. It's actually quite permissive. if you use it as a residence on a regular basis, and certainly a cottage property would be one that most people would do that, it likely will qualify as a principal residence, but you still have to qualify for the principal residence exemption once you've qualified the property itself. So in order to have that principal residence exemption, it is available to all Canadian residents. You don't have to be a Canadian citizen, and the property itself can be in Canada or someone else or somewhere else. So sometimes people will have a property just over the border in the States, for example, and maybe even a cottage property, and that could qualify as a principal residence. The calculation, and I'm not going to try and give you a detailed example here, but the calculation of the principal residence exemption is basically dividing the number of years that you want to claim the property as your principal residence by the number of years that you have owned it. And if you only own one property, that's not going to be a problem. You just claim it for all the years that you've owned it. But if you have a crossover of owning two properties, or maybe even more, during the same crossover years, then if you claim the principal residence on one of them, it reduces the number of years that you can claim the principal residence on the other. Now, some people will ask, in my calculation here, what does that 1+ years claimed mean? What is it for? Basically, because you logically will have to buy and sell property during the course of a year, even I suppose if it's on the first or the last day of the year, you can have the entire year associated with one property. But if you do it at any other time, then you're going to own two properties that potentially could be your principal residence in a given year. So to acknowledge that, the calculation just gives you the number 1 to make sure that you don't lose out on the capital gain on one of the properties as you go forward. So you'll get it on each of the properties on a continuous basis, and it is about the number of years that you own it, not about specific years, choosing particular years where it suits your purpose because there is particularly high growth in those years. It's the quantity of years, not specific years. So let's give you a little bit of an example. And if I've heard this once, I've heard it 1,000 times. We're gonna retire, and we're gonna sell the house, and we're gonna move up to the cottage, and it'll be our principal residence from that point forward. And we're going to claim the principal residence exemption on the house when we sell it. And now that we live in the cottage, it's our principal residence. And so we completely get rid of any capital gains on these residences that we have. So here's what really happens. You don't get to do it quite so. I mean, it's a nice, generous rule to get the principal residence exemption, but it's not that generous. So here's my example that I use, where you have the house that you buy in 1990, and you buy the cottage in the year 2000. I'm using real round numbers again. And then you sell the house in 2020, and then eventually you're going to sell the cottage out there in 2030. So you've got 20 years of overlapping time between these two. When you sell the house in 2020, so after owning it for 30 years, you've had 20 years of concurrent ownership. If you then claim the principal residence exemption for the house over that time period, your full 30 years, then you're not able to claim the cottage as principal residence, or claim the principal residence exemption for the cottage for those overlapping years with the house. So if you'd sold the cottage the same year as the house, then you would not be able to protect any of the capital gain on the cottage if you had first claimed the principal residence exemption on the house. But in my example, I'm carrying it out. You continue to own the cottage all the way out to 2030, and then you sell the cottage at 2030, and there's no other property transactions going on. At that point, then you'll be able to claim the principal residence exemption for 10 of the 30 years that you own the cottage in that case, because again, we had those 20 overlapping years between the house and the cottage. I'm going to stop there because I know as I'm going through it, it makes the greatest sense to me. But you tell me, Paul, is that good, or you want me to reinforce any of that, or did any questions come up on that?
Well, it's good. I guess the question I would anticipate is, I think people accept and understand that you can't claim the exemption on both properties. But can I get creative about which 10 years I pick for the cottage? Or in this example, would it only be the 2020 to 2030 years where I could claim the exemption because I've already claimed it on the house?
Yeah, right. And this is reinforcing that point about selecting years. So particularly as we sit right now, for some bizarre reason, we've seen the real estate markets, particularly the cottage markets, just go haywire last year. Who would have predicted, one, we have a pandemic, and two, that it would have that kind of an effect on real estate? So last year, if you got to cherry pick which years you wanted to have as the years to attribute to a given property, you'd want to pick 2020 because the market spiked up, and whether they dropped back down again or just stayed flat, you would have wanted to choose that particular year. But you don't get to do that. You just do it based on the number of years that are owned. And so in the example that I've got here, once you do come around to selling that cottage, I've shown them visually as if the growth is on a straight line and it's the same growth for the house and the cottage. And obviously that's not the reality of how that would operate. But it is the number of years that are associated with it, not the specific years that you choose. You know, the year the Blue Jays actually won the World Series. I want that one because everybody was willing to buy these condos downtown Toronto, and so they were just going crazy. And I owned it at that time. No, you don't get to do that. It's just the number of years that are owned that you have to do the comparison between the two. So, okay, so should I continue on then, or do you want to hold me up still? Or?
Yeah, no, that's good. Oh. Thank you.
Okay. Okay, so when you are looking at transferring property, I just want to get the groundwork of the ways that multiple people can own property. And multiple people is just say more than one. Where we have spouses, we quite often, generally, people will assume in a lot of cases that ownership of property, and particularly joint ownership of property, is something that is directly associated with spouses, married or not. But it is actually possible for more than just spouses to own property together and to own by right of survivorship through joint ownership. So I'll give you the two main ways that you can own property. Joint ownership, as you see here, is where we have two or more, but I'm just going to keep two here. We don't need all the extra circles involved. Two or more people who own the property together own 100% of the property, all right? And what happens is, upon the death of either of these joint owners, or if there were more than just two of them, any of the joint owners, all the continuing joint owners will continue on by what's called right of survivorship as owners of that property. So the property interest of the deceased person does not fall into that person's estate. It goes over to those other joint owners, which is one of the reasons why joint ownership is helpful when we talk about probate tax, particularly between spouses, that if everything's going to go over to the surviving spouse, then why have it go down through the estate, have to go through the probate tax calculation, and then go over to the surviving spouse? Much simpler to have it as jointly owned between the two of them, and then it streamlines the